Fidelity Enhanced Reserve Fund, also known as FERF, is designed to optimize your cash allocation and aims to provide an attractive level of risk-adjusted total return. Popular among investors, the fund has raised over $1.7 billion since its launch in 2018. Its performance since inception has withstood many episodes of volatility. FERF was designed to solve an age-old dilemma of investors. Here is the basic concept of the Fidelity Enhanced Reserve Fund, using a chart of return versus risk. At the bottom left-hand corner, we have money market funds, where clients would traditionally park cash, which today yields close to zero. In the opposite corner, there are generic risk assets, equities, bonds, and FX. Asset classes that not only experience extreme volatility this year, but are back at expensive valuations after a Q2 performance rebound, despite being in one of the toughest market conditions ever. Investors may be thinking about moving from money markets into risk assets, but are worried about buying at the peak. Or they may be thinking about de-risking their investments, but are put off by the virtually zero return on cash. This is where FERF comes in. It looks to offer features similar to money market funds, namely liquidity and stability, but with enhanced yield. With the priorities of liquidity, stability, and yield in mind, the fund has the following features: T+1 settlement, allowing investors to switch into other asset classes without worrying about source of funding. Expected annualized volatility of 1% for the underlying pool of assets. The average credit rating of FERF is around A-, with average interest duration between half to 1.5 years. The fund's underlying portfolio is designed to generate a yield that would exceed money market funds. We achieved these features through a typical asset allocation of 20 to 30% in cash and cash-like instruments, 50 to 65% in short-dated investment-grade bonds, and lastly, 15 to 20% in short-dated high-yield bonds. It is these allocations that give the characteristics of FERF: liquidity, stability, and yield. Here, we show a chart of FERF's performance since inception. The performance up to February 2020 had been steady and stable, just as we expected it to be. There have been some sell-offs from launch to February 2020, but the fund's decline during these sell-offs were relatively mild. Its largest drawdown since inception to February 2020 was 0.3%. Next, let's extend the chart and look at how FERF fared during the sell-off in March and its subsequent recovery. The drawdown in March looks exaggerated due to FERF's usual stability. The maximum drawdown in March was 3.81%, and its one-year net return had been positive, something that can be said for many other asset classes. Its recovery was also remarkable. Within 3 months from the trough, FERF's NAV already exceeded its pre-sell-off peak. FERF combines the advantages of cash, short-dated investment-grade bonds, and short-dated high-yield bonds. Fidelity, given its experience and track record in managing these investments, is uniquely positioned to manage this product.
Potential investors should read the prospectus before investing in the fund. The value of the units in the fund and the income accruing to them, if any, may fall or rise.